Good afternoon. This is Market Sense right here on ET Now. Well, ahead of the crucial WPI numbers that we'll be waiting for, let's just take a look as to what's happening with the currency as well as the bond yields. Equity markets holding up, and that's only aiding momentum for the currency markets. 62.48 for the rupee against the greenback. In fact, it did touch a 4-week high amid increased capital inflows as well as the dollar selling by the exporters. Not just that, you've got the dollar's weakness against some of the overseas peers. That too is strengthening the momentum, and in fact the dollar index has fallen near those one-year lows. For the bond yields though, you've got them currently at close to 8.43. That's at a 1-week low on an intraday basis, and in fact the range for that is close to 8.35 to 8.5% for 1 week.
Okay, WPI data coming out any moment now. Let's get in our battery of experts to speak about their sense. Samiran Chakrabarti, Dr. Arun Singh, Sangeeta Purushottam. In a bit, Maithili would also join us to speak about her sense. Thanks so much for joining in, all of you. Samiran, about time for the WPI to come in. What's your expectation? Around that 5.5 to 6%?
I think that's a broad range. Anything which is within this range will kind of be ignored right now by the markets. But the focus will be on the core inflation number. In the last print, it went up. So if that trend continues, then that RBI should face some concern on that front as well.
I think that the full impact has not been passed on, Samiran, because August 2 it spiked, and if indeed the spike continues, then maybe the belief would be that it could spill over with all the petrol price hikes that we've seen as well, that it will spill over into the coming months too. Absolutely.
This month's print has a very strong positive base effect, because of which inflation numbers should be lower. But we will try to dissect this number to see to what extent the exchange rate pass-through is still happening, to what extent the oil price increase in August is getting factored in the crude oil component, to what extent chemical prices are reflecting the exchange rate pass-through. So these will all be dissected as we get the details of the number. But overall on the headline, looks like 5.6, 5.7 is where this number should be.
5.6 to 5.7, that's a stand chart view. Let's also get in your opinion, Sangeeta. You just did have Samiran focus on those core inflation numbers. Given that it has been spiking on a month-on-month basis, what's your expectation?
Well, I think, I don't think we'll get too much comfort in terms of, the numbers reducing, because the other effect that we're going to start seeing in the coming months is the companies taking price increases on the back of the rupee weakness. So many companies have either announced it or about to announce. So I think that is going to lead to some kind of a pickup in manufacturing inflation, which has been, soft in the past. That, along with the fact that we still have a long way to go in terms of bringing parity in terms of petrol and diesel price hikes, actually does not give you a strong case for saying that inflation numbers are going to come down significantly.
Dr. Singh, wanted to get in your expectation for the inflation numbers, because this is certainly going to be rather crucial in terms of what the next monetary policy step is going to be with RGR now at the helm.
Definitely. First of all, we need to understand this is not an easy time, and for inflationary pressure as a whole, absolutely not. And of course, inflation is likely to be close to anywhere between 6.3 to 6.4%. But this number is just the, to say the first month of beginning, I can say. Going forward, maybe next 3 months, we can see the significant surge in the inflationary pressure going forward, because we have not seen and we have not felt that the complete pass-through has not happened yet. And there is going forward, I think some amount of easing is expected from the primary article side and food article side, given the good monsoon. But on the manufactured inflation side, fuel group is all set to go up, and I expect by December, I think it could be anywhere between 7.5 to 8%. Post that, there might be some recovery. There might be some moderation in the price post December onward, but next one quarter, I think this is very critical, and of course this is very critical and very crucial for September 20th policy.
Maithili Busnurmat, consulting editor of ET, joins us on the show as well. Maithili, good as always having you. Lots of key data points coming up as well, but just first focus on the WPI numbers today. They won't be make or break, right? I mean, Samiran pretty much gave that view as well.
Yeah, I don't think they would be make or break at all. I would tend to agree with Sangeeta that there's very little reason to expect that there would be a sharp decline. In fact, if at all, even if we don't see much movement this month for the month of August, going forward we would expect the WPI to go up. And there was also a reference to RBI's monetary policy on the 20th. I think given that Raghuram Rajan has already said that he's going to have inflation index bonds, but indexed to the CPI, I think maybe one could expect a slight change in emphasis in the RBI's policy stance, that they would be looking at CPI. They always did in the past, but maybe not explicitly, whereas now I think I would expect them to look a little bit more closely at CPI rather than the WPI, the wholesale price index, because if you are going to come out with inflation index bonds linked to the CPI, then you do need to look at that CPI much more closely than you did in the past.
Samiran, just wondering if it comes northwards of 6%, say 6.1% or thereabouts, Grapevine seems to be suggesting that. Do you think that the markets kind of take it into stride and, as Maithili was saying, focus a lot more on CPI, because the markets would also tend to believe now that even the central bankers would start focusing a lot more on CPI because that's probably the more relevant one?
Well, the move from WPI to CPI is unlikely to happen overnight. So at least for the time being, the RBI will have to keep WPI also in mind. And that's why if we get a 6% plus number on WPI, I'm sure at least temporarily it will spook the markets. It will start creating noises that the tightening might stay longer than expected, and that's going to dampen the sentiment quite a lot.
We just had Dr. Rangarajan also making some comments a short while ago, saying that he will consider inflation and forex markets on policy. When it comes to the overall policy movement, Sangeeta, you just had Maithili saying that the emphasis might now go on the CPI inflation numbers. What's your sense?
Well, certainly. I mean, that's something that, the governor has clearly mentioned, and that is something that experts in markets have been discussing even while looking at the inflation numbers earlier, that, it's really what happens to inflation on the ground. It's how you and I experience it when we go to buy things that's going to determine a lot of decision making in terms of how much money you put into financial assets and what goes into deposits, etc. So I think that's clearly a welcome move, and it's definitely the direction to go in for.
Joshi, how do the next couple of months look like, assuming that the WPI number comes in slightly higher than what the market has been working with? In fact, okay, we're just getting the inflation data out, just coming to you, gentlemen. 6.1%, our poll suggested 5.9, the broad range was 5.5 to 6%, slightly above estimates. Let's get in those initial comments. Maithili, to you first. At 6.1%, I think the equity markets got a whiff of it and just started cracking a little bit. But at 6.1%, alarming, do you think, or it's got more to do with probably the fuel price data, and that may correct itself in the coming months?
Well, it is to do with the fuel price data, and it may correct itself in the coming months, particularly if food inflation. We'll have to look at the breakup to see what is it. Is it manufacturing items? Is it fuel? Is it food articles? What is really contributing to the core, to the WPI inflation? But I think 6 was like a benchmark, anything. So sentiment really matters, because whether it's frankly between 5.9 and 6.1, there isn't that much of difference, particularly given the quality of our data. At the same time, 6 would be like some kind of a benchmark. So 6.1 is certainly not very good news, but we'll have to see what the breakup is. If food inflation seems to be substantially higher, 18.81 is 1.8 as against 11.9, and that really is very worrisome for a government which is going for election mode. So you can't afford for the good harvest to come in and wait for prices to fall. Manufactured items is much better, so clearly the RBI's policy has had success as far as manufactured products is concerned, but food inflation is going to be very, very worrisome for the government. So frankly, I don't see much relaxation on terms of monetary policy, really.
That's the point, actually. Look at fuel and power, that is 11.34 versus 11.31. So no change out there. It is the food inflation which has spiked up. And Samiran, contrary to the belief that a few people had that the spillover of last month's fuel spike might continue, that has been stable. So that hasn't led to the increase. It's food inflation at 18.18 versus 11.91. Your initial thoughts?
Yeah, 18% food inflation is definitely very worrying. Possibly both cereals and vegetable prices must have gone up substantially. This might be good news for people expecting that rural consumption will pick up on the back of this. But unfortunately, since the new governor has clearly mentioned that even supply side factors causing inflation will be in his radar, I suppose that the markets will now have to be veering to the fact that there is not going to be any significant easing in monetary policy going forward, even on the short end of the curve. And the long end of the curve definitely is going to be pressurized from these inflation risks as well as risks of fiscal slippage.
62.7 for the currency, and yes, Neeraj did mention that the equity markets did get a whiff of that number. So while we were holding steady above the 5,900 mark, that's been breached on the downside. The Sensex too has come off from the day's high. Dr. Singh, let's get in your assessment of the inflation numbers. Clearly, food inflation continues to remain the culprit at 18.18%. Fuel is fairly stable. The primary articles has inched up to a double-digit number of 11.7%. Would you concur with Samiran that now we cannot expect any monetary tightening from the Reserve Bank?
See, definitely, and the fact is that food inflation and primary article inflation is not a culprit now, it's culprit since 2006. If you see the primary article inflation, average inflation since 2006 is close to 11%. Food article inflation is close to 10.5%. Fuel group since 2010 it's close to 12%. So I mean, these are the structural issues. I mean, this can't be corrected through the monetary policy easing or tightening. The monetary policy works better in the manufactured article, which definitely works since 2005. If you see the manufactured article inflation is just below 5%, which is encouraging in fact. Now the point is that how fast, from my perspective, I see RBI should continue with the rate cut policy, but looking at the larger issues, larger concerns, if not controlled at this point of time, it will have the spillover impact on the manufactured article as well. On the other side, we have a currency depreciating, that is the biggest concern. So I think RBI this time they might hold the interest rate at the same level.
Sangeeta, there's also another view that, despite all of the macroeconomic data that's been pouring thick and fast back home, it's really not too much that the RBI governor can do. His hands are tied and will be largely determined, the actions will be largely determined by the Fed meet. Do you concur?
Well, I think it's both. I mean, the fact that our policy was postponed to after the Fed meet indicates that clearly we need to take cognizance of what's happening globally. But I think the domestic factors are equally, if not more important, because a lot of the issues that we find ourselves facing are self-created, and many of the solutions also lie at home. So, it's really a question of what is it that that's in your control, and what is it that you can do. That's what you need to focus on, and that's really in the domestic domain.
Maithili, two questions really. One is the question marks on the food inflation. Incidentally, the market has come off even further now, 5893. So just before I go to our guests, just show the intraday of the index. Awan just pointed it out, but now just about 16 points. So 5866 for the Nifty, just about 0.5% for the Sensex. Sangeeta, actually a follow-up to you before I go to Maithili. How does the market read into this? Do you think the market says that, hey, we rallied some 15-16%, combination of global and local factors, RGR coming into play as well. Now with inflation showing the spike, maybe the rate hikes are not coming, and therefore good time to take money off the table and sit on the sidelines, probably even go ahead and short the market. How do you think the market looks into this?
Yeah, I think the market certainly doesn't look at these numbers positively, because we do know that there are other factors which are going to keep the pressure on inflation on, and the implication of that is that we are not going to move to lower interest rates in a very short time frame unless and until we have tamed inflation, and many of the issues facing inflation are structural in nature. So my own sense is that we need to live with the fact that interest rates will remain firm for quite some time to come, particularly at the long end. At the shorter end, many of the measures taken were temporary or said to be temporary in order to basically bring stability to the currency, and there some hope lies, but the longer term interest rates, I think, need to be firm for a while.
Maithili, I was coming to you. Why this divergence? CPI inflation was down month on month, but WPI comes in northwards of 6.1%, and despite all the talk of good monsoon, food inflation spikes up alarmingly high.
Well, it is the spike in the food inflation is particularly alarming, but if you look at the overall numbers, the movement is not that dramatic, and there's always been a difference, a fairly wide divergence between CPI and WPI, essentially because of the baskets, the composition of the CPI and WPI. So that has always been a divergence. So actually, if you look at the trend, the movements have been less sharp. Food inflation alone this month has been very dramatic, and there's one more factor which actually might come to our benefit. So even though we are seeing a spike, you can call it 5.9, 5.7. 6.1, you can call it, if you can call it a spike, which I don't. It is definitely an upward movement, but there is something we may get sucker from an unexpected source, and that is, there is talk that Larry Summers is withdrawn from the race for the chairmanship of the Fed, and if that happens, the next candidate who is most probably leading from the front is Janet Yellen, and she is known to be much more of a dove than Lawrence Summers. So if that happens, the US dollar will remain weak for some more time. Weakness of the US dollar helps the Indian rupee, and to that extent imported inflation may come down. I may be clutching at straws, but I think one shouldn't dismiss it. In fact, some of the weakness of the US dollar that you're seeing today may be just possibly because Larry Summers is no longer in the race. Of course, we could have a dark horse completely, but if it is Janet Yellen, as indications seem to be at the moment, we can expect the Fed to continue its dovish stance for some more time.
Okay, you've really put that well into perspective. But Dr. Singh, let's also get in your opinion on the same, because the food articles being up over 18% for the WPI inflation, whereas for that CPI inflation did manage to cool off at 11.06%. What's the reason to your mind for this kind of a divergence? Because it has been a good monsoon.
See, definitely we should understand this. Both the methodology is different, composition of the commodity is different, weight assigned to each commodity is different, and of course there are two different agencies is releasing the and then survey method is different. So of course there will be some divergence going forward unless we align both methodology and methods to the same level. This divergence will be there even in the future. I think we need to believe that here the commodity baskets and weight assigned to each methodology is different. So I mean this the divergence will be there in a future. I think.
Great, Dr. Singh, good having you. Thanks so much for joining in today and giving us your perspective and your views. Samiran, you started off this conversation saying that the chances of a rate cut are slimmer now than what they were. I've also heard a couple of people say that there might be minor tinkering on the upside with the rate.